All right, live stream here. We're going to be talking about the current state of fixed rate mortgages in Canada. I'm Rob Campbell, I'm a mortgage broker here in Ontario, and we're talking, as I said, about where rates have gone. Well, the Bank of Canada made an announcement last week about the variable rate mortgages seeing a quarter of a point decrease. Many bank analysts believe that it is the second of four to happen this year. Whether or not we actually get the four, who knows? Bank of Canada Governor Tiff Macklem has made it very clear that he wants to really watch where the CPI numbers, unemployment numbers, the economic numbers come in to see whether or not they're going to continue that march down. Also making note that the way down from here is going to be a little bumpy at times. But many bank analysts believe and economists believe that we'll see four rate decreases this year. We've already got two under our belt. Let's take a look at the screen here for the 5-year government bond yield. This is what fixed rate mortgages are based off of. And if we go to the 5-day, you'll notice a consistent downward trend moving into the end of the week. But if we actually scroll back out for a month's worth, again, a continued drop. We were at 3.615, and now as of today, we're at 3.05. That's a decent half a percentage point lower. Is that the percentage point that's already happened, or is that maybe the economy anticipating a September rate cut from Tiff Macklem and starting to price that in? We didn't really think that fixed rates would, in the last couple of months anyway, we really didn't think that fixed rates would drop a crazy amount, because these drops are kind of already baked into these yield pricing. But what we are seeing this week is more continuous drops, and that's getting most mortgage rates now. Most mortgage rates are in the 4% range now, whether that's a high ratio purchase in the 4.5% range to a conventional refinance rate, which is traditionally higher, more expensive. We are seeing those now touch the 4%, the high 4%, but they are in the 4% now. So what happens when we see mortgage rates at in the 4 range and qualifying rates up in the 6 range? We generally see activity. We see excitement in the marketplace. What are we not seeing? Excitement in the marketplace. Resale numbers are down over the 5 to 10 year average for real estate transactions, that is, and prices are still low. Some pockets are seeing an improvement in price, only slightly, but the market is still holding back. And why is the market holding back? Probably because the economy sucks. People don't have the money. Yes, mortgage rates are coming down, and traditionally, me personally, have been of the mindset when rates start with a 4, we see great things happen in real estate. Well, it's not happening. Why is it not happening? People are paying more for gas, for groceries, for childcare, for transportation, for car loans. Have you tried to buy a car lately? Financing's crazy on cars. Just the general population is starting to hurt more and more and more. What we tend to see is actually worse numbers as we slide into a recession. As the Bank of Canada starts to lower the rates, we traditionally start to see lower economic certainty and good news. We actually start to see more bad news, layoffs, less spending, which leads to more layoffs, and it's a bit of a cycle downward. So it's interesting to see these fixed rates starting to really slide. I mean, we saw a high there back in what is that, April, end of April, where the bond yields seemed to kind of peak back there and had a good run in late May, a month later. But now they've continued their slide down. So this is really interesting. What does this mean? What does it mean to you if you have a fixed rate mortgage coming up for renewal, or you actually have a purchase you're thinking about purchasing, and maybe you're wanting to purchase in the next 4 to 6 months? Well, the really key thing I can think of off the top of my head is make sure your banker or broker is staying on top of rate decreases or float downs. We have the ability to reach out to our lenders up until a certain point of closing, maybe a week before closing. That starts to get tight, especially if you're purchasing. Your lawyer can't really redo the paper packaging and the numbers, but make sure you're keeping tabs with your banker or broker to float down your rate. If you're 2 or 3 months out from renewal or a purchase, they should be able to start to get you those lower rates. Some lenders start to get a little wishy-washy on lowering the rates as we move forward. But most lenders will allow you to continue to float it down. You could save yourself a bunch of money by doing that. It really costs nothing to do. Just simply reaching out to your broker or banker and saying, hey, I see rates are lower. What can we do? And it's just a simple request into underwriting to get those drops. So again, pay attention to those rates where they're going. And you could save some money, even if it's on a shorter term, like a 2 or 3 year term. You could save some money moving forward. So that's the YouTube live video for today, just to take a look at where the bond yields are. That's what I'm covering today. I'm hoping to put out a live every day, every work day of the week, to keep people more informed and go over some current market stats, but also some mortgage jargon. If you found this helpful and useful, excuse me, please hit the subscribe button down below and give me a thumbs up. And even if you want to ring that notification bell to get new videos when they get posted. Thanks so much for watching. I appreciate you. Take it easy.